Hey everybody, it's Marshal with Bridgestone Homes. So a common question I've been receiving with interest rates going up is how can you protect yourself? And what do you do if interest rates increase while you're under contract? So stay tuned, we'll talk about that today. So the Federal Reserve has actually increased rates multiple times. I think we're talking 4 or 5 times already in 2022. Now we are coming towards the end and it started to level off a little bit, but a common question we've been receiving is like, how do you protect yourself? If they happen to increase again, and while you're under contract even, how do you protect yourself and how do you make sure you're getting that best deal? And there's really 3 things to really pay attention to. So most people are going to say just assume you're going to have a higher interest rate. But what's unique is there's a few ways you can actually go about making sure that doesn't happen. The first immediate one is maybe prepare to have a quicker inspection period, because the quicker your inspection period's over, the faster you can actually get your loan officer to order the appraisal. And then from there, you can lock your interest rate relatively quickly to make sure that you at worst are locked in at that rate. Now, a unique point about locking your interest rate, most people don't know, is you can actually unlock your interest rate. So if interest rates happen to come back down, all you do is you unlock your interest rate, which I would really encourage you to ask for your loan officer to pay for this because it's more than fair, but unlock your interest rate and then lock it at that lower interest rate. It's playing the game, and that's part of it. The next thing to really pay attention to is maybe buying your interest rate down. And that's really a conversation of how risk tolerant you are to that equation, what your interest rate's going to be. One option is you can actually permanently buy your interest rate down. Now, the risk of that is that if interest rates happen to come back down in the next year, it's pretty much wasted money. But if they go significantly higher, you have no risk of your interest rate ever increasing. So that's the safest way to make sure that at worst, your interest rate stays here. Now, another option for an interest rate buy down is actually called a 3-2-1. You also have a 2-1. So it's based on chronological years. So a 3-2-1 would be the concept of if market rates are at 6.25, for example, your first year of interest rate is actually going to be a 3.25. Your second year will be a 4.25. Your third year would be a 5.25. And then the highest your interest rate will go is at 6.25. So for your first year, you're 3% less, saving thousands and thousands of dollars, because if you bang your buck, if you really bet your buck that the interest rates are going to come down relatively quickly, this is the smartest way to do it. I am a little bit more risk tolerant, so that is what I would do if I was purchasing a property. I would do a 3-2-1 buy down and prepare myself for when interest rates come down. I go refinance, and then whatever's remaining of that amount that the seller gave from seller concessions to buy your interest rate down, you literally put it towards principal payoff. So you're getting free money at that point. So those are going to be the 3 biggest topics to pay attention to when you're purchasing a property. Just make sure you know that you're protected and that your professional you're using, whether that's your loan officer or your agent, has this information. Feel free to share it with them. That's what I'm here for. If you have any other questions, feel free to reach out to me, comment down below. We'll be available and we'll be in touch.